Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion, we will be talking about overbought and oversold market conditions, at least briefly. Then we'll be working our way into overbought and oversold indicators. These are indicators that can help us better identify when the market is said to be in an overbought or oversold stage. This is the kind of information that will hopefully give you that competitive edge that you need to finally pass your Gauntlet Mini. If your goal is to become a professional funded trader, then you need all of the information that you can muster. And in order to stay up to date with all of the information that I can share with you, please do me a favor and click that like and subscribe button down below so I can keep coming out with informative content for you all out there. But without any further ado, let's dive on into that material and learn a thing or two about overbought and oversold market conditions. The oldest principle in trading, and investing for that matter, is to buy low and sell high. The best way to do that is by finding opportunities at trading levels that represent something below the intrinsic or fair value of an asset. We can think of this as finding discrepancies and seizing the moment right before that particular asset's price gets corrected. To capitalize on these kinds of opportunities, traders rely on indicators that help them identify overbought and oversold market conditions. So let's dive into exactly what an overbought and oversold market is. The terms overbought and oversold are used to describe an asset's price relative to its fair intrinsic value, and they help us define the current market conditions as well as future trends to help us identify those buy and sell signals that we're all looking for. When we define an asset as overbought, it means its price has been going up consistently. As a consequence, it's now trading at a higher price than it might be worth. As a result, its price has reached a tipping point and we can expect it to drop. The pullback happens once traders unite around the idea that the asset is now too expensive. On the other hand, an oversold market is when the asset is trading below its fair value. Alternatively, when it is worth more than its current price, this is said to be the same scenario as an oversold market where it's trading below its fair value. Oversold markets usually appear when there has been a continuous selling of a particular instrument to a point where the traders start thinking that its price has hit a bottom. Oversold markets signal the end of a short-term decline and usually represent the start of an upward rally. Overbought and oversold levels signal that markets have matured and seen prices hit extremes. Market participants' overreactions usually cause these conditions to begin with. They may include increased buying or selling activity resulting from recent news or earning releases, or just relative technical analysis market movements. Based on the tools used to determine the overbought and oversold markets, there are two categories of market conditions: fundamentally overbought and oversold, and then technically overbought and oversold conditions. So we have the fundamentals and then the technicals, the core of trading. And as their name suggests, to determine the instrument's reasonable price, the former, meaning the fundamental, relies on those fundamental indicators and industry factors, while the later, talking about the technical overbought and oversold conditions, employs technical trading signals to come to this conclusion. Being able to recognize overbought and oversold markets is the cornerstone of a sound investment strategy. If you can identify overbought and oversold levels, you will guarantee that you are buying and selling at the best possible price. Assets' prices can't move in one direction indefinitely, and at some point, they will turn and embrace an opposite journey. Being able to time that moment right just before it happens is what turns a good trader into a great trader. The essence of strategies based on identifying overbought and oversold markets lies in their ability to predict when the expectation of the looming price, or drop or increase for that matter, will materialize. These signals allow traders to buy at a lower price and sell at a higher one. We're looking to maximize our returns this way, and this helps us by making the most out of whatever the current market conditions are. While all of this sounds great on paper, the truth is that identifying overbought and oversold markets might be a little bit challenging for first-timers and even slightly experienced traders. Some traders spend years polishing and mastering their trading strategies specifically built around identifying those overbought and oversold conditions, but if you think of the value that becomes of a trader once they are able to correctly do that, it is always worth it in the end. Now we can move into talking about various indicators that will help us identify those overbought and oversold market conditions. Investors usually rely on fundamental indicators like price to earnings to spot those overbought and oversold markets, but traders on a shorter term basis will oftentimes employ technical indicators, such as the stochastic oscillator as well as others that we're going to talk about. The stochastic oscillator is one of the most popular indicators that's currently used for identifying overbought and oversold markets. When it's applied to the chart, as you can see here, we can visualize the indicator as a line that is going to be moving between a value of 0 and 100. We represent this oftentimes as oversold when we're below 0 and 20, and that would be represented by this little red box down here. And when we're up above 80 to 100, we usually consider this to be an overbought area in the market. So what does this tell us? Well, the overbought signal generated by the stochastic oscillator, such as up here, this indicates that there may be a looming bearish market, and it could be a good time to sell to lock in the profits that we've gained from a potential long position that we're already in, or perhaps we're just interested in opening a short position to take advantage of that potential drawback that might happen. On the other hand, when the market is oversold, down here where we see the red box between the 0 and 20, this is exactly the opposite. It could be a good time to close out the shorts that we already have open, or a good opportunity to look for a buy opportunity into the market in anticipation of some bullish momentum to come as we find equilibrium in the market between these overbought and oversold regions. Another thing that we can use the stochastic oscillator for to help us find those overbought and oversold conditions is by paying attention to when the indicator is preemptively moving in a direction that price is not. This is called a divergence. We have an example of one here and here. If price is rising but the indicator is falling, we can use that as an indication that ultimately price will probably begin following the indicator. The reason behind this is because the indicator is usually leading price with its read in this particular case, and as such, if the indicator is rising but price is falling, once again, we can look at this as an opportunity to expect a reversal with what price is currently doing. The Relative Strength Index, otherwise known as the RSI, is very similar to the stochastic oscillator in the context that it also measures price momentum to identify those overbought and oversold conditions. The main difference is the RSI doesn't rely on a simple moving average as a second line. The general interpretation of the RSI is that we're usually looking to sell when the indicator climbs above its 70 reading and then falls back below. So we're looking for it to rise above, fall back below, and then enter in for a short. When we're looking for a buy, it's the exact opposite now with the 30 reading. So what we want is we want price to fall below 30, then climb back above, and look for an opportunity to buy into the market. Now, as with all things, of course, we want to pay attention to outside price action when using these indicators. Next, we have the Bollinger Bands, which are arguably one of the simplest indicators to use and most beginner-friendly when we're looking for those overbought and oversold conditions. Bollinger Bands is a pricing channel that consists of 3 lines, all of which generally use a 20-period SMA. If the price breaks the upper line of the band, this is said to be a condition that is overbought. If the price breaks the bottom side of the band, you guessed it, this is said to be a condition that is oversold. Simplistic concept behind this would be that we're looking to sell when we are outside the upper band and looking to buy when we're outside the bottom band. Now, we want to always understand that if the market is gaining strong momentum in one direction or the other, it is possible that the price itself will stay outside the band representing the direction the market is going. So the indicator, while being simple, can provide two very opposing reads, and for that reason we always want to be good at identifying the market conditions outside of what the indicator is showing. That way we can further confirm with what the indicator is telling us. And what I mean is, if the market is trending upwards strongly, there is a good chance that we'll see price outside the upper band for a lengthy period of time. So if markets are extremely strong with what they're doing and we break outside the upper band, we can actually use that as an opportunity to buy. But if the markets are more sideways and we break outside the upper band, that would be more representative of that overbought condition that we talked about in the beginning, where we could look to sell. The Commodity Channel Index, otherwise known as the CCI, is a momentum oscillator that further helps us identify overbought and oversold market conditions. The indicator's initial idea was to reduce the uncertainty that was caused by cyclical and seasonal markets in the commodities markets, but today it's a great tool used by traders of all market types to help predict upcoming trend reversals. On a chart, the indicator is plotted as a line that is fluctuating back and forth. Generally, we're paying attention to the ranges of -100 and +100. When the indicator leaves these ranges and extends beyond those directions, that's when we say that the market is either overbought if we're above +100 or oversold if we're below -100. The way that we're looking to trade with the indicator is quite similar to the previous ones that we're talking about. When we are overbought, we might look for opportunities to sell. When we are oversold, we might look for opportunities to buy. Up next, we have the Parabolic SAR, otherwise known as the PSAR. And this really isn't an indicator that's well known for identifying overbought and oversold signals. However, many advanced traders do in fact use this indicator to do just that. If you're a newer trader, this isn't the one that we're going to recommend for you. We'd more say stay closer to your RSI or stochastic oscillator, but the PSAR is something that monitors price changes and the speed at which they occur, which means as we're paying attention to where these dots are located, we can use that information in conjunction with price action to further identify where price is overbought and where price is oversold. That might look something like this, where we have the dots on the bottom side indicating that we're in a bullish move in the market. Then we notice that we've encountered resistance, which is our price action skills. That, coupled with the fact that now the dots have flipped to the top side indicating bearish activity, we can use that to say this is an overbought area in the market and look for a short opportunity. The opposite would hold true for a buy. If the market is showing us a downward price move that is in line with bubbles on the top side, then we find some type of support, and we couple that with the dots then flipping to the bottom side, we could view this as a potential area where the market is said to be oversold and look for an opportunity to buy at this location. Next up, we have the indicator with arguably one of the longest names in the technical analysis world. It is the Moving Average Convergence Divergence, which is otherwise known as the MACD. The MACD is a nice abbreviation, and that's how you'll hear it if you look around the internet. And this is an indicator that is taking advantage of a 12-period and 26-period exponential moving average, which is plotted alongside a histogram. The idea here is that traders are looking for when the MACD line is crossing over the other line. We have a signal line and a MACD line, and traders are paying attention to the interaction that these lines have. When the MACD crosses above or below the signal line, we're considering the market to be overbought or oversold. An overbought reading will occur when the MACD crosses below the signal line. An oversold condition will be when the MACD line crosses above the signal line. The process for entries here is quite similar to the previous indicators that we've talked about, where if the market is overbought and we couple that with price action, we're going to look for an opportunity to short the market or close out our long positions. If we have an oversold read because of the cross that we just talked about, then we'll be looking for an opportunity to buy into the market, and as long as we're coupling that with price action, we should be quite happy with what we're finding. In summary, overbought and oversold conditions are areas in the market where we're expecting some type of correction or reversal to happen. If we're correctly identifying overbought and oversold conditions, we are, in essence, predicting the future. And as a trader, that is exactly what we're looking to do. We're looking to weigh out the probability of a particular move. If the market is incredibly overvalued, it would be logical to expect it to fall, and if the market is oversold, then it would be logical to expect it to rise to find that fair equilibrium where price is truly valued. Until next time, folks, I hope you have the best of luck in your trading and great luck with those of you that are going on to your Gauntlet Mini journey. I'll be here waiting for you on the other side. Over and out.